Um, but there's no clarity as far as, but restaurant to restaurant. Some restaurants, it's like, yeah, that's completely replacing your tip. Some places they're still expecting you to tip on top of whatever the service charge is. And a couple weeks ago, the DC area restaurant industry group, um, they published a survey that 44% of restaurants in DC are saying that they might have to close this year because uh, this was passed with really limited consideration as far as how does this impact economics of consumers going out to eat, and but really the labor costs involved uh, for uh, the restaurant industry. And as much as can be said about tipping culture in the US, it's a
Yes,
ingrained
my
part
lord.
of
Well,
our economic
also it's
attitude. And I think similar is true with manufacturing, that we've seen such a decline in manufacturing that, yeah, we can bring it back to some extent, but it's so fundamentally different from what we see as,
Your orders, my
t-shirt
lord.
factories in uh, whether that's in Honduras, whether that's in Vietnam, China, wherever. Uh, and so this idea of just we're going to bring it back, it becomes difficult to work with for a lot of companies.
so
With
do you
text with textile, go on. I was going to say with textiles, basically, it's pretty much impossible to bring it. It's very, very difficult to bring it back. I mean, you're looking at Bangladesh and other countries, and like with Vietnam included, and they've basically specialized in those industries. I think it's important to point that out. Whereas the US in what in what he wants to achieve is essentially diversification. I think it wouldn't necessarily work when it comes to manufacturing again. The US is already a services based oriented economy, so I just
I
don't
think
think
Cricket's telling us
it's
that we're not going to have closed.
Yes, my lord.
well,
Yes.
so I wanted to push back on two things that we had just mentioned here. First, comparing restaurant labor to manufacturing labor is, I understand where it's coming from. However, manufacturing labor in most areas of the U.S. is still above minimum wage. So, in a lot of ways, what's happening with the raising the minimum wage isn't necessarily putting direct pressure on being able to, you know, afford to produce that widget in a manufacturing line, but it is causing you to have to push up wages in a more long-term way. Is everything else in the community becomes more expensive?
Right, well, and the manufacturing that's performed in the US tends to be either higher skilled, or there's an apprenticeship process, or there's, in the case of oil and gas, there's physical danger. Um,
It's high
that
value
We
pay.
shall engage.
Right,
We
and
shall
you
prevail.
don't.
Yes.
The U.S.
my
just
lord.
doesn't have a.
Joining forces, my lord.
You don't have sort of this industrial base of people who do make near minimum wage doing sort of unskilled assembly type work. One of the things that's come up that I've talked to a couple of people about with the tariffs is also that tariffs generally apply on the value of the item that's imported, and how one of the reasons you historically have seen this huge push to free trade is that using tariffs and duty that way tends to be very technically difficult to do, because companies are very strongly incentivized to cheat. Or if not cheat, let's call it optimize the way they deal with the tariffs. And so that turns into things like, okay, well, with my t-shirts, well, I could still get all of, 90% of the work done in Honduras, and then just have a robot in the US that just, staples the two pieces together. And so you see a lot of weird sort of
My lord.
Yeah.
industries where you
Yes.
sort of break up how
Without
a product
question.
is made, not for a industrial economic reason, but for a tariff optimization reason. And with,
With
20 to 30%, you have a lot of slack to do, to do that kind of change.
when you do these tariffs across the board like that, though, and when it's not across like the HTS category, it's actually country to country. You just really, it's going to be hard to find economics of getting something partially assembled and finishing it here in the US. To try to
So
avoid
the
tariffs.
example I would use, I use with people for this is, let's say we have a stuffed animal factory, and we'll assume that it's in China, and it's for tariff declaration purposes. What is the incremental value of, say, a stuffed rabbit's head? And it's realistically, the value of a stuffed rabbit's head is mostly the stuffing and fabric that goes into making it, not the fact that it's happens to be rabbit head shaped. The same's true of the stuffed rabbit's body. Its value is very, very low until we put the two things together. And so what you see a lot of, and we see this some in oil and gas, when, say there's a country that has very high tariffs on heavy machinery. What you would do is you import all of it in 2 or 3 pieces that individually have very little value. And then you do the, value add in the destination country of, okay, well, we're going to do the final assembly step that takes this from being, 10 cents worth of stuffed animal head and 15 cents of stuffed animal body. So we paid 25 cents in tariffs on that. We pay people to sew the heads on the bodies, and then we sell them for $30.
Your orders, my lord.
Yeah, so you
And
see a
that-
lot of sort of
Yeah.
We
gaming
shall
that,
continue tomorrow.
particularly with these kinds of products where
Yes, my lord.
where you do each step is fairly arbitrary.
We will see how
Yes,
long
my lord.
this admin permits something like that. It doesn't start trying to do things to
Stopping
discourage
here.
that. So I think it's a matter of time until that pisses them off.
Yeah,
Um,
well, you
I
look
also wanted to say that as we're talking about wages here, some states, I'm forgetting which ones. I think Alabama is one of them. They've permitted per piece labor again, so you could conceivably pay someone per piece when you're manufacturing something like a shirt, and in theory, maybe not pay them the full minimum wage, depending on if the feds are willing to step in or not on that. And that might make some of those
That's,
states more competitive for this kind of
I
manufacturing
mean,
if the labor pool is accepting of that.
that's something that I noticed in, what was it, Texas? I think it's Texas, New Mexico, and I think you can here in Nevada. That's what a lot of places do now with things like, say, kitchen cabinets, where their workers are paid, $30 a pop to install them.
As you wish.
Yeah, that's still pretty high value
Urging
though.
armies, my lord.
I'm
Right,
thinking,
well, and it's taking that same model. If you keep going down,
Joining
if you're a
forces,
really
my lord.
slow kitchen cabinet installer, you could end up below minimum wage. But when you take that same thing and you apply it to t-shirts, and it's 50 cents, not $30, it's easy to see how, okay, you could theoretically
Your
run
orders, my
this
lord.
as far down as you needed to. And I think
Yes.
that's where you get into the problems with the labor pool itself, where ignoring the morality of running a company that way, how do you convince anyone to do that?
I just don't think people accept it. People simply in the US or in the West overall, people just won't accept that form of payment. I think therefore it just completely wouldn't work. But it's interesting to think.
Well,
I don't know, because
well,
we
yeah,
already have
the
that.
economy.
if you set the amount high enough, presumably most people would accept sort of payment by work piece. The problem I think you run into is there really isn't anyone who's going to give up their current job, whatever that might be, to go do that.
Yeah, exactly.
It would work if you had, say, a massive group of people trying to immigrate, and you are kind of letting all of them in. You could come up with a way to make that work by saying, okay, this is a job that pays enough that you could start to get established and do that sort of thing. But it goes back to the kind of conversation about anything that someone does in these new factories means they're not doing their old job. And so the factory job has to pay roughly what their old job paid to get them to agree to do that.
So
And that's
one of the things they could do here to kind of access that labor pool, or to access the labor pool that might be more willing, is they could start bringing back work requirements on Medicaid again and SNAP benefits, which is something they tried heavily during the first Trump admin. We haven't really seen them try too hard this time, but the regulatory landscape and legislative landscape for that is more favorable now to making someone work for Medicaid or work for their SNAP benefits.
That
will
is
say-
something. I think I'm the only person here old enough to remember, the whole thing with welfare becoming workfare, and that whole thing under Clinton where some of those benefit programs turned into like, okay, you have to be seeking a job.
Yes.
And I think the problem you really run into is if you look at even, say, like the SNAP benefits someone receives, the dollar amount in benefits they receive is still more than you can pay someone to sew up a t-shirt. Yeah, like there's just not, like, we're orders of magnitude apart from places like Vietnam that have built this, entire industrial base around having cheap labor and the materials available.
And I also know, for most people's edification here, the way we pay prison labor here in the U.S. usually is per piece, and it is usually some 50 to 20 cents per piece. So this is something that isn't totally foreign to being done here in the U.S. It's just we typically don't see it outside of prison or incarcerated populations in the sub-dollar per piece realm.
So
Okay.
I do have I've had this kind of inkling that there might be something like if you wanted to achieve that kind of like market shift where there's already like set up people paid for these kind of jobs, you almost need like a massive amount of job destruction and then recreation, which like with the transition from taxi to Uber and Lyft, where you just end up with this massive shift over. It's a completely different system. It's a different employer. That's the kind of thing that you'd have to have. And I don't think anyone. I still, every once in a while, I think about the fact that we have low unemployment, and that's driven some wage growth. But I do have this kind of like worry that somebody in the administration might be stupid enough to think, what if we just blew stuff up a little bit to get that kind of economic shift?
And the tariffs definitely do that. You have, if you sort of play that whole thing out and you go, okay, well, we want this shift, and the only way to get there is going to be to destroy a notable segment of the current sort of employment for Americans. Doing things like dropping massive tariffs out of nowhere will do that. I think the question is it possible to end up with the same or more productivity out of those workers? When Japan did this experiment with protectionism and that sort of thing, they found it really wasn't. And that's why you had, the lost decades with Japan, is you have the actual productivity of workers didn't go up, so you kind of couldn't go anywhere.
And we have a question from Ray, like, could this whole, like, we want more people in manufacturing, like, could that be part of why they're riffing Fed workers? And I don't think that that's the cause for the rifts. That this is a administration that seems to be hell-bent on we want a small government, small in quotes, because we'll see what actually comes of it. But certainly that's been some of the reaction, I think. that that they're not necessarily firing all these Fed employees to provide a manufacturing workforce, but people have been saying that they're all getting laid off, and so they can go take jobs in manufacturing. But I mean, again, these are a lot of people who have very specific skills. They they may be able to make comparable money in manufacturing compared to what they made in government. Especially, government's not always the um, it isn't always high paying, but it's gonna pose barriers. I don't think that that's the reason for firing all of them. And then
Also, there just
Yes,
aren't
my
enough
lord.
of them. Like,
yeah,
if you go, okay, I want to make T-shirts out of fired with Fed workers. It's okay. We fired all of them, and we've covered 3% of the labor that we need.
yeah. I mean, I don't even think we've talked about getting into hundreds of thousands yet. I think we're still somewhere in the tens of thousands. I want to say. Even though with planned layoffs, it's not going to get close to covering everything. Then, real quick, because we've had Clear join, we did introductions with Moto, Astro, myself. We've had Clear Signal join, and then we have Cricket who joined. Do y'all want to do quick intros on y'all's background, real quick?
Sure. So I've been in Project Alpha for like 5 years now. In terms of
Your
my
orders, my
background,
lord.
yeah, I've had some experience in economic research. I personally study economics as well. So in terms of an
Yes.
academic and work experience
Making
background
camp
there,
here. My
I have
king.
that. Anything in particular you want me to cover too, in terms of my background,
Yes.
or is it just
Joining
general?
forces, my lord.
Think that works?
Yeah, that's great.
Yeah, so I'm Clear Signal. I've been here forever. But my background is I've worked kind of cross-sector, across multiple sectors, private, public, everything like that, and I've applied that and experience here to watching the markets and kind of watching trading in crypto and stocks and just kind of a retail trader background. And so I'm kind of bringing that to the table, just looking at different sectors and kind of talking towards issues there.
And I think that sets up a good transition. This whole sort of idea for the talk started out of a lot of the discussions
my
in
lord.
market and finance, where people have,
Orders.
Your orders.
okay,
my
what do you
lord.
think the market's going to do with
To
this?
battle. We shall
Um,
prevail.
and what,
Yes.
what could retail investors do, or
Yes, my
sort of
lord.
what's the best way to handle it?
With honor.
I think
Assembling a mighty host.
my big
Your
takeaway from
orders,
this
my lord.
conversation and others that I've had is that no one really has a great feel for how to make this work.
As you command.
And so that means that, there's not going to be some, the whole market and every company piles into one way to solve it for those companies. There's no clear cut good move for them to
Muster
make.
your courage, men. We march into
So to
battle.
me, obviously that suggests that what we're looking at is, mostly inflation and volatility, that it's not, it'd be very difficult to do things like, try and position yourself well with individual companies, just because the way each individual company reacts is probably going to be very unique to the circumstances of that company and the sector they're in.
I do think, as far as like the investing angle of it, this entire thing, except for a few smaller elements right now, is predicated on future events, future things, and maybe some people taking bets on what's going to happen. We're not dealing with like a crisis of some instrument failing, some bank has done something and now there's no money in something and it's collapsing. We're talking about planned policy implementations. Like we have one set in place now. We're still waiting for the other one to come in, and the uncertainty that it could just either it stays forever or it evaporates tomorrow. That's a huge gap of uncertainty. Like how do you navigate that as far as
well,
the investor's sentiment goes? Because the
so I
volatility is everywhere.
posted, right, so I posted a series of charts in the text chat here. That's a couple of currencies, the S&P 500, oil, natural gas, and then some precious metals. And one of the things that strikes me looking at it is normally these assets don't correlate. If nothing else, gold moves differently than everything else. It's interesting to see an event where there is strong correlation with everything. That normally kind of can't happen.
Right. Usually you walk from one side of the room to the other side of the room. Somebody's left the room here. Some group of people,
Right.
and we've said that it's probably cash, right?
Right. Well, it has to be because you don't, whenever you sell a stock or you do, you sell any financial instrument, you're left with cash that you then presumably normally would put into something else. So you'd go, okay, I think, this is going to be bad for US companies. I'm going to sell my stocks and I'm going to buy, I don't know, gold and inflation adjusted treasuries or something. And what's particularly strange about this is no one's doing that. You don't see the spike that you would expect to see in gold. You don't see the spike you would expect to see in other currencies. You don't see it in equities. Traditionally, sort of the way you deal with inflation as an investor is avoid things like bonds. Equities tend to outperform bonds with high inflation because they're tied to the underlying assets of the company. Or you go into things like precious metals and sort of all the other flight to safety things that people do.
Yep.
In this case, we don't see them doing that because the same sort of thinking and policies that create the uncertainty and the risk and making people want to sell also means you don't really want to go into something like, say, U.S. Treasuries because, well, Trump decides that the Treasury rate is exploitative and he's not going to pay something. You can't. The whole point when you're doing those kinds of things is changing what your risk is and what you're exposed to. And I think one of the things that this whole set of policies has done is shown that, okay, if you have a US administration that thinks in this way, you can't really avoid exposure to that risk. That if you were to say sell US stocks and you're going to buy companies, say in Europe, where you're still impacted by that set of tariffs, you can't, for investors, there's no sort of safety to flee to. And then that means that all the money that's coming out of the system right now does literally just sit as cash, which it can't really do for very long. And that's
Right.
something that generally drives inflation incredibly strongly, because if you're stuck with cash and you don't like your options for investing in, none of them seem to deliver a return or they seem too risky or whatever it is, you spend the money.
Yep.
Because at least if you spend the money, you have a thing. And so that's something else on the inflation side that, totally ignoring how the tariffs work, even if we just assume magically it all just happens, you still have this massive amount of cash that's come out that, it's nowhere near enough money to pay for, say, building all these factories. And we've talked about all the different risks that would go into doing that. So it's probably not going to go there. It doesn't seem to want to go into treasuries. It doesn't seem to want to be precious metals. It's not going into equities. And you run into this question like, okay, well, where the hell does that go?
I mean, I know there's No. I was going to say some stuff about municipal bonds, but it's like that's not even a thing, really, for this. But for a little while there, because I saw this mentioned elsewhere.
And Alpha's correct. They should go with Pokemon cards.
That is a good one. I do appreciate that one. Mine have held value, so that's good. The the thing that I saw mentioned
We'll
elsewhere
pump and
was
dump
that
with Pokemon cards from Clear Signal there.
I'm just saying. Um,
They're a
that
great store of value.
it's gonna be my inheritance to my children. So I saw somebody else say that, which is kind of an older way of thinking about them, that crypto at one point was the flight to safety for a second for some of the more volatile traders that were like looking for a game to play. And that seems like it's kind of died off, and now we're getting this kind of linkage where the market goes, the cryptos kind of go too, which I wonder if that's linked to that we've got more institutional investing, and so then not sure if that's shifted things a bit. It's like it's not a safe place to keep your money, but it is definitely a game to play, and I feel like we're seeing some of that play out now too.
Well, and it used to be, crypto's very much tied to sentiment. I mean, even more so than other asset classes. And so, I think you have a thing where when people are nervous, they kind of close out of everything. It's not. Crypto tends to correlate now pretty well with, like microcap stocks and other things along those lines that have similar volatility profiles.
Yeah, it seems like it's almost included in certain portfolios now that when they act on their smaller stocks, they also are acting on their crypto. Like, how do they feel about it? The whole thing as a set. I don't know how much that ties into things. That's just the feeling I get from when I watch things go up and down. I kind of see them move together.
Right. Well, and that's, normally, so going to like the institutional investor perspective, one of the things you look for are assets that don't correlate with each other. Because what you're looking for are things that can regularly deliver returns, and they don't. Sort of the classic set would be, say, the S&P 500 and gold. That if you think the market's going to go down, you can buy gold, and if you think the market's going to go up, you can buy S&P 500 or futures on it. And so, normally you saw a fairly strong negative correlation between the two assets. And what's been unique with this as an event is that everything is fairly well correlated. And so, it goes back to that, okay, every single trade someone does, there has to be a counterparty. If you sell something, there's someone else who's buying it. If you buy something, there's someone else who's selling it. And usually what that means is that for them to buy your thing, they had to sell some other thing.
Right.
So you almost have to have something that has a negative correlation because it has to be the thing that other person is selling.
Right. Well, then that gets down to the ravenousness of activity, right? Like if you have a lot of people looking to get into things, it'll drive stuff up. I mean, this is simple. Like this is the basis of what's happening in like market buying and selling. Like that's really, really rudimentary stuff we're talking about here.
Right. Well, and that now, notably, a lot of the development around how you price those things and how you think about those things is no one's thought about tariffs like this since that happened.
Right, and that's why you get a lot of people who are asked questions about it, and I feel like they try to fall back to this traditional model, and they're just like, well, it always turns out okay. And it's like, well, if they are really trying to change the way the status quo works, that's there's gonna be a lot of people who are just like they have to find some new way of thinking about it and talking about it. You're kind of shifting this fundamental how we've operated for what was it? What's the last time? Like I want to say it's like almost 40 years, right? Like we haven't had something even close to this. And then that's just a sort of thing from like the Reagan era of doing things. And even before that, you go all the way back another 40 years.
Right. One, you have to go to find this kind of thing discussed as like a serious policy conversation. You either have to go to like the 30s or like the 1880s. And that predates a lot of the theory and a lot of sort of the work that went into the idea behind sort of the modern market, efficient markets thesis. And so that means that the models that you can go off of that people have come up with don't have the same assumptions that, say, an institutional investor has. Pretty much every institutional investor that currently exists is either going to be someone who believes in very efficient markets or someone who very much believes in, sort of rates as market intervention. Because those are kind of the only two schools of thought left standing. And so all of sort of the financialization stuff that's happened over the last 50 years is built in those two frameworks. That sort of like those are the only two ways this can possibly work. And all these policies we're looking at aren't even really contemplated in those systems. They would just be viewed as like destructive. The whole idea is that you have rational actors, and if you don't, none of that economic theory works.
Rational actor theory in today's day and age.
I mean, we're
Usually
talking about
people at least want to make more money.
the basis of this kind, like the way they're operating. We can literally right now. It's so funny that it's happening at the same time, but I mean, obviously it kind of has to. But look at Iran, the whole Iran-U.S. thing. We've got this whole brinksmanship, I'm going to destroy you kind of approach that Trump has to his foreign policy. That I'm going to make it seem like I'm about to level the whole place before I go to peace, right? You bring that to economics, you get that kind of uncertainty. There's a whole lot of side effects that happen. It's not just we can just go back to what we were doing because this is how it works. It's a whole new ball games when you're winning the actual, like, it's not business that's doing this. It's not a like strong arming another business to sell to you. It's you're the government and you're doing it, and it starts a entire different dynamic of uncertainty.
In that destruction doesn't generally happen from the specific policy. If you told every company in the United States, that next week all their stuff was going to cost 15% more, and you didn't change anything else, you just said, we're just going to do this once, and I don't know, we'll use the money to pay down the debt or whatever. Business would handle that fairly well because it's very predictable. So everyone goes in and they adjust the models they're using and they say, okay, well, this happened. And so now, this factory has to earn a 2% higher return, or this asset's not, this isn't going to cover the cost of capital, or things like that. With this, the destruction doesn't really come from the financial side of the tariff so much as no one has any idea what asset does well. If you look, through the chat, everyone's talking about, here's what gold's done in the past and what people do with bonds. And, one of the things we talked about earlier is, when everything's going down, what that tells you is the money isn't really going anywhere. It's just sort of sitting off to the side, waiting for someone to have a plausible thesis for where they should go with it. I mean, when we
Yeah,
talk about
and
this dollar amount, I think what was it on between Thursday and Friday, there was something like $9 trillion in value that was removed. There aren't
I
a
thought it
lot
was
of
thousands.
asset classes. Well, there just aren't really that many asset classes you can throw that much cash into.
yeah, I mean, and a few minutes ago there was a question from I have the storm, like, what are people buying though? And Astro, yeah, that's what you're talking about a little bit ago. That it's like this is going into cash right now, which isn't sustainable long term. And so I think that's kind of what the scary thing is, that people are pulling money out of all asset classes, they're putting it into cash, and that whether
So I'll
they end up
post.
going and buying products and and driving inflation, or even if that cash is just sitting. I mean, and I don't, as much volatility as there is, as irrational as the administration is, and as much as we don't know what's going to happen, I don't see bank collapses and or bank runs, or even the FDIC getting taken away. I don't see that particularly happening, but it poses an issue for institutions if people are pulling out of investments and just holding cash. Even if they don't spend that cash and they're just holding it, then that can lead
There,
to issues, for
right. Well, I
various
mean, you even just get
financial
to.
institutions.
I mean, you even just get to things like, say, for a bank, and it's reserve limits and things. You can't throw $7 to $9 trillion of cash into banks. Because they can't do anything to earn a return with it either. So there's a chart I'm going to post. This is the future spread on crude oils. This is what I was looking at this morning, where it was really obvious that the market has no idea what's going to happen.
These are wonderful drawings of spiders you've sent us.
Yeah, it's like those fireworks on the ground that
Yeah.
they
I will say,
normally you have like a nice curve that's if inflation's going to happen, then the back prices are higher and all that. And with this, it's just like, well, who knows?
so I
Yeah,
will say, and this is really more of a question to y'all, but as we're talking about these asset classes, we've been in kind of like a venture capital winter here for about 5 years, where returns were so great in other sectors that no one wanted to put money into venture capital firms. And I've been wondering, is now the time where we see additional money flow into these VC
I do think in this
funds?
environment, it is probably a lot easier. So just speak more from like the private equity side of it. It's a lot easier to raise money in those sectors with this kind of environment, because you're sort of counterintuitively, your risk premium becomes lower because everything is risky.
Yeah, that's
Your
100%.
risk premium is driven by like the difference between the risk of this and the risk of that. And if everything's incredibly risky, then it's like, well, screw it, go for something where you might get 10, 20, 100 times your money.
Right. If you see
The
them as
biggest-
like tables, like if you're looking at like a casino floor and you see them as tables, suddenly all the games are risky. Why not go for the one that might have a high payoff? Like you're just looking for the game to
when
play.
you do with venture capital,
That was kind of a loaded question, because I've already personally, I've taken some risk here at this point since the beginning of the
in
election,
venture
because
capital,
it seems like it might be the place to go.
well, in venture capital, in a lot of ways behaves very similarly to sort of consumer spending, where if you have really, really low risk, it goes up, and if you have really, really high risk, it goes up. In the middle, everyone puts their money into stocks and bonds and things like that because you get a pretty solid return because there is some risk, but there's not a massive amount of risk. It's not the biggest problem I see with venture capital in that role is really just a scale problem. That if you are an institutional investor or you're a family office or you're someone who manages a few billion or $100 billion, it's incredibly labor intensive to analyze assets, and you're constantly spending all your time trying to find the next things that you're going to put those assets into.
Well,
And
and then
the
there
problem,
just isn't going to be trillions of dollars worth of startups to put assets into.
well, so what happens is the sort of startup economy will grow to soak up as much capital as people would like to burn. That what happens is the quality of the ideas that get funded goes down, or
Yeah,
the
and then your
average
due
quality.
diligence, right? And your due diligence isn't there to really
Right. And
find those out.
it's important to remember those investors on the other side of that are in many ways compelled to participate. They have to place the money. They can't just sit on billions of dollars in cash. And so even if they want to do a lot of due diligence and they want to make good investments, what happens is, on say a given quarter, you may have a list of 150 things that a firm's going to look at, and basically they'll fund it from the top to the bottom. And so more things get funding, riskier things get funding, but at some point working with those companies, you have meetings where everyone in the meeting knows that an idea is bad, or that the people who are trying to do it cannot do it.
I've been in many of those. Yes.
But you end up investing in them because you don't have a choice. You have $50 billion to place. And so, well, these people suck, but they seem to suck a little less than the other places we could go at the bottom of the list. So fine, maybe they won't destroy all our money. Maybe we'll get half of it back when we sell their office furniture. And that, you can do that. It's just as you have more and more money in that system, the quality of the businesses that get invested in tends to go down.
Well, it makes everything very frothy, right? Not necessarily a bubble, but you have a lot of little things that happen like that. I mean, I feel like I've been through now 3 of them, 3 waves of them,
I've been
where
through
you
a
end up
couple
with
VC
software.
bubbles at this point.
Yeah. There's plenty to pick from. But back in I want to say it was 2010, when video chat became really big, there was a whole lot of VC investors who would go through and jump on chats, and it seemed like everyone had a VC at that point, down to like individuals who were like, I'm doing this thing, there's a bootstrap website, let's give me some money.
That
And
still
that
works,
still
by the
happens.
way.
Yeah, no, I know it's still a game that you can play, just not as well. Now they're React websites, so yeah.
So that's
Yeah,
interesting.
so
Marty
one
McFly
question that
is something really interesting.
So we'll go over that in a sec. There's one thing Tony brought up about how mass wealth equality, is that a prerequisite for having so much venture capital go into, let's call it, bad ideas? What's interesting with that is when you have, if someone's managing money, whether it's their own or other people's or your CalPERS or your whoever, the whole time you're doing that process, you're constantly seeking places to put money. You know, your compensation is driven by the return that you earn and how much money you're managing. So if I place an extra $50 billion, my firm, you know, may earn an extra $1 billion in fees, even if there's no return from that money. So you're constantly trying to find places to put things. What wealth inequality does is moves that, kind of decides whether you're more playing on the private investor side, where the way you tend to get private investors is a narrative. You know, you have a story about why your product is revolutionary or why your idea is great, and either they're super enthusiastic and they buy into it and here's some money, or they don't and you stop talking to them. With institutional investors, it tends to be more about how your product fits into their investment thesis and their sort of model of how the financial system works. You know, does it seem like this idea will earn enough return to cover the risk of the idea? You know, they don't believe in you or not. They just sort of, it fits or it doesn't. So yeah, no, on Marty's link that he posted about, you know, trading desks. So I was working with a company